Valued investors, October and Halloween are now in the rearview mirror. Yes, I ate too much candy over the last week against my wife's wishes. But frankly, the U.S. government is still shut down. Now, history suggests that shutdowns tend to be short-lived and have minimal sustained impact on the economy or the stock market. Investors have smartly looked past budget disruptions throughout history, rightly focusing on traditional fundamental drivers of the economy and stock market, such as corporate earnings, consumer spending, business investment, inflation, and interest rates. That said, sectors heavily reliant on government contracts, such as defense and life sciences, may experience some short-term volatility. An extended shutdown, which could delay key economic data releases, could detract slightly from economic growth, but is unlikely to be material in our view. While we see rising odds of a 5 to 10% pullback, risk to this bull market appears low, thanks to a resilient economy, strong earnings, the resumption of the Fed's rate-cutting cycle, and long-term catalysts like AI-driven productivity gains and fiscal stimulus from the One Big Beautiful Bill Act. So what could spook the markets? The four most dangerous words in investing, this time it's different. The market has climbed about 35% off of the April lows, sitting near record highs. But as any seasoned investor knows, calm waters can hide deeper currents. So today, we will look at a few potential scares that could rattle investors and how we are thinking about them over the long term. The first scare is the late cycle economy and job growth. The U.S. labor market, which has powered the post-pandemic expansion, is slowing. Job growth is barely keeping up with population gains, and unemployment has ticked up. If hiring stalls further, consumer spending, which drives 70% of GDP, could weaken. That is why the Fed remains sensitive to employment data and continues signaling rate cuts to cushion the slowdown. As Warren Buffett reminds us, be fearful when others are greedy, and greedy when others are fearful. We are watching closely for signs that fear may actually create longer-term opportunities. We're also watching valuations, which are nearing dot-com era highs. The S&P 500 trades at approximately 28 times current year earnings, nearly matching the 1999 peak. AI enthusiasm has pushed tech to about 35% of the index. High valuations do not necessarily predict an imminent crash, but they often mean muted, longer-term returns. Unless productivity gains from AI are truly transformative, future returns may be back to longer-term averages of mid to high single digits versus the recent 3-year run. We're also watching surging margin balances. Leverage has surged and exceeds 1990s and mid-2000s and post-COVID periods. Margin debt on the New York Stock Exchange has jumped over 32% since April, a level of leverage last seen before past corrections. Add in 0-day to expiration options and leveraged ETFs, and speculative exposure is even higher. History shows spikes often precede bouts of volatility. It is not a reason to panic, but it is a reason to stay disciplined with risk management and avoid chasing momentum. We're also watching Fed rate cuts. The market is now expecting more rate cuts going into 2026, which would push the Fed funds rate below 3% next year. That might sound bullish, but if inflation stays sticky, the Fed could lose credibility. Too much easing risks unanchoring inflation expectations. Too little easing could cause a painful bond market repricing. Either way, bond investors face a damned if you do, damned if you don't setup. We are keeping neutral duration on high-quality core bonds and shorter duration on high-yield bonds, which is where risk-reward looks more balanced. Despite these scares, we're not running for the exits. We remain neutral on equities, with a bias to buy the dip rather than chase the rally. AI investment, rate cuts, and healthy corporate profits still provide meaningful support. Seasonality is favorable heading into year-end, and deficit spending continues to buffer recession risk. History doesn't repeat itself, but it often rhymes. So while markets may get a little spooky, long-term investors who stay diversified and patient usually come out ahead. Near-term volatility is possible. The broader outlook remains constructive. We encourage investors to emphasize stock market fundamentals over negotiations on reopening the government and consider pullbacks as potential buying opportunities. As always, stay safe and stay the course.